Ever felt like you're trapped in the endless 9-to-5 cycle? Wake up, squeeze onto the MRT, rush through meetings, OT till late, and before you know it, repeat the next day. Many Singaporeans tell me the same thing. They don't exactly hate their jobs, but they don't love them either. The truth is, most people are stressed, tired, and sometimes even unhappy at work because they feel like they're working hard, but not really working for themselves. If that sounds familiar, stay with me till the end, because today I'll show you why it doesn't have to stay this way, and how planning long-term with dividend investing could be your way out. And before we dive in, do me a favor, like this video so more Singaporeans can watch it, and subscribe to Wealth for You for more simple, down-to-earth money lessons that build passive income. Disclaimer: this video is for education and entertainment only, not financial advice. Please always do your own research before investing. Chapter 1. Why people feel unhappy at work. Let's be honest for a moment. So many Singaporeans wake up every day, put on a smile, and head to work. But inside, they're exhausted. Why? Because the routine feels never-ending. Wake, squeeze on the MRT, rush through meetings, then repeat tomorrow. You give your best years to a company, but at the end of the day, you're still replaceable. And no matter how hard you work, your paycheck is always tied to your time. It's like trading away the prime years of your life, only to hope that when you finally reach 65, you'll have enough health and savings left to enjoy a little freedom. Imagine spending 40 years running on that treadmill, and the prize you get at the finish line is just a few short years of retirement. That's not the life many of us dreamed of as kids, right? Chapter 2. How to solve the problem. But here's the good news. There is a way to break out of that cycle. The answer isn't to quit your job tomorrow and leave everything behind. That's too risky, and most of us still have bills to pay, kids to raise, parents to support. The real solution is to quietly, steadily build a second engine of income while you're still working. Think of it like this. Your 9-to-5 job is one engine keeping the plane in the air. But if that engine fails, or if one day you just don't want to fly it anymore, you need a backup engine to carry you forward. Some people try side hustles. Some invest in property. But for many Singaporeans, one of the most accessible and reliable ways is to build passive income through dividend investing. This isn't about getting rich overnight. It's about creating a plan so that one day, even if your boss doesn't need you anymore, your money will still be working for you, day and night, rain or shine. Chapter 3. What is dividend investing? Dividend investing simply means putting your money into assets, like stocks or REITs, that pay you regular cash payouts. Think of it like planting durian trees. At first you wait patiently, but once they mature, every season, the fruits drop and you enjoy the harvest. For example, when you invest in CapitaLand Integrated Commercial Trust, every quarter you receive dividends funded by rents from places like Plaza Singapura or Raffles City. That's income flowing to you, without you needing to sit in meetings all day. Chapter 4. Macro Backdrop. What's happening in markets? Now let's zoom out and look at the bigger picture. The U.S. job market is weakening. July job openings fell to the lowest level since 2023. That's a clear sign the economy is slowing, and when that happens, the U.S. Federal Reserve usually steps in to cut interest rates. Markets are already expecting an almost certain cut this September. So what happens when rates fall? Bonds go up because yields drop. Stocks rally since companies can borrow more cheaply. The U.S. dollar weakens, which often boosts Asian currencies like the Singapore dollar. Gold has hit record highs, around $3,500 per ounce, as investors look for safe havens. Oil prices have softened from earlier highs, recently hovering in the mid to high $60, reflecting some pressure from slowing global demand. Now here's the key for us in Singapore. Interest rates and REIT performance are closely tied together. Why? Because REITs are like giant landlords. They borrow money to buy properties, then rent them out. The lower their borrowing costs, the more rental income flows back to us investors as dividends. When rates are high, REITs face two problems. Higher financing costs eat into profits, and investors compare yields and say, why buy a REIT at 5% yield when T-bills pay 3.5% risk-free? But when rates fall, those headwinds turn into tailwinds. Debt refinancing becomes cheaper. REITs yields suddenly look more attractive compared to safer assets, and valuations often rise as investors chase stable, high-yield income. We've seen this in past cycles. After rate hikes pause and cuts begin, SREITs have historically rebounded as capital flows back into yield assets. For instance, Ascendas REIT's tech parks and logistics hubs mean steady rent. Lower rates help more of it flow through as dividends. Mapletree Industrial Trust, with its data centers, benefits from AI demand, and cheaper financing supports expansion. CapitaLand Integrated Commercial Trust, with malls and offices, sees lower borrowing costs improve its payout stability. So while a weaker U.S. labor market may sound like bad news at first, it could potentially create a more supportive backdrop for Singapore REITs in 2025. Of course, markets are never certain. This is a scenario, not a guarantee. But the macro environment looks more favorable than in recent years. Chapter 5. Why SREITs could rebound in 2025. Now let's bring it back home to Singapore. Our REITs have taken a beating the past few years. Rising interest rates pushed up borrowing costs, investor sentiment dropped, and unit prices were dragged down. Many Singaporeans who held REITs felt the pinch as their portfolios turned red. But here's where the story starts to turn. As we move into 2025, the stars are slowly aligning for a rebound. First, the rate cycle is shifting. With interest rates expected to come down, REITs can refinance more cheaply. That means less money going to the banks and more rental income flowing back to you, the investor. Second, Singapore's economy is holding strong. We're growing at around 4.3%. Inflation is under control, and the Singapore dollar has strengthened over 6% against the US dollar. That makes our local assets even more attractive, especially compared to other markets. Third, valuations look compelling. Right now, SREITs are trading below book value, less than 0.9 times price to book. Think of it like buying a $1 property portfolio for 90 cents. On top of that, many REITs are yielding above 6%, much higher than government bonds. And don't forget, their balance sheets are in good shape, with average gearing under 40%. That gives them room to manage debt without over-leveraging. Now here's the exciting part. The rebound isn't limited to one or two sectors. It's broad-based. Tourists are back, filling up hotels and boosting hospitality REITs. The surge in AI and cloud demand is driving Mapletree Industrial Trust, with its high-value data centers and industrial spaces. Healthcare REITs continue to shine as a defensive play. People still need hospitals and clinics regardless of the economy. Even the previously sluggish retail and office segments are starting to show signs of life as shoppers return and businesses adapt to hybrid work. Now let's make this more concrete with a simple example. Suppose you put $10,000 into CapitaLand Integrated Commercial Trust today. Its current dividend yield is about 6%. That means in 1 year you'd receive roughly $600 in dividends, enough to cover a month's worth of groceries or your phone bill for the year. Scale that up. If your REIT portfolio grows to $100,000, that's about $6,000 in yearly dividends, or $500 every month. That's passive cash flow dropping into your account, rain or shine, while you continue working your day job. This is the power of dividend investing. Even small steps today can snowball into meaningful financial freedom tomorrow. Final thoughts. Here's the big takeaway. If you're feeling unhappy at work, don't rush to quit tomorrow. The smarter move is to plan a way out by slowly building long-term passive income streams. Dividend investing may not sound exciting, but it's reliable. And with potential rate cuts on the horizon in 2025, REITs like CapitaLand Integrated Commercial Trust, Mapletree Industrial Trust, and Ascendas could be well-positioned to reward patient investors with both income and stability. Remember, your 9 to 5 doesn't have to define your entire life. Start planting your durian trees today, and over time, you'll be able to enjoy the fruits of financial freedom without waiting until retirement. If you found this video useful, do give it a like, share it with a friend who might need this encouragement, and subscribe to Wealth for You, where we make dividend investing simple and practical for everyday Singaporeans.